Chief Investment Officer Gary Reynolds is with me today. Gary, thank you for your time over the recent weeks. And right now, I am back. We've had the base rate go up to 3% yesterday. We've got all these words in the media like worst recession in 100 years. Is inflation set to push the UK into recession? Grim horror show for Sunak and Hunt. What's your views?
Well, generally, the opposite happens to what the main forecasts are. You know, media and economists are dreadful at forecasting anything. When you get this kind of hype, the worst tends not to happen. Now, I think that some form of recession is probably likely in the next year. I'm not sure it'd be anywhere near as bad as the Bank of England is predicting. We still have a shortage of workers in this country, and there's still a high amount of activity, and consumers have got a lot of money, and that's what's been pushing up. Inflation, and is why the Bank of England have responded. But some of the reasons for this coming Armageddon are cited in areas such as the UK and then particularly the US housing market. And of course, people have got memories of what happened in 2007, 2008, where a crisis in US housing affecting the mortgages that were secured on those properties, leading to the global financial crisis. And there's the old adage that generals fight the last war. And I think that we tend to worry about the thing that happened most recently. But it doesn't look like anything is going to happen similar to that. And I suspect that if we do have a recession, it's more likely going to be a mild one. We may have a couple of quarters, perhaps 2 or 3 quarters of negative growth. The definition of a recession in this country is 2 quarters of negative growth. And you know, if that's at 0.25% per quarter, it's not too bad. If it's 4, 5, 6% in the quarters happened sort of in 2020 and then back into 2008, 2009, then it's not so. It's clearly not so nice. But no, I'm a bit more optimistic than these forecasts out there, Leo.
Gary, what would you say to, firstly, investors and secondly, individuals and families just going about their daily lives when we've got all this going on? We've got products getting more expensive, and we've also got talk about stealth tax. We'll have a piece out alongside this about that. What kind of pressure is this putting people under, and what would your advice be to them?
Well, we tend to only look at one side of the balance sheet, don't we? We look at what's happening to the borrowers. How much does it cost to service a mortgage? How much does it cost now to buy a car? What we forget is there's 2 sides to a balance sheet, and the whole thing has to balance. What about all the extra income that is going to people with deposits, which are quite substantial? So on the one hand, whilst it's more difficult for some families, it's better for others. What I would say is when you get this sort of reversal, you may get a change in asset pricing, but income can still be maintained quite strongly. So let's say you take an older person that's got a couple of $100,000 in a building society account. They own a house, let's say it's worth $1 million, and along comes a nasty increase in interest rates, pushes the price of their house down perhaps 50 grand. Doesn't make much difference to them because they're not consuming the property, they're just living in it. But if it gives an extra 3 or 4% on their deposit rate, then suddenly they've got another £500 a month coming in from their cash assets. So it goes 2 ways, Leo. It's not all negative. It's just that what I think is difficult is that the policy of austerity and the slow growth after the global financial crisis has put more of a burden on a worker on average income, a young family trying to make their way, than it has for a retired person that's got capital. And I think that the government need to be very mindful of that. And I'm not sure a fresh batch of austerity thumping the living daylights out of lower paid in this country is going to be the way forward.
Let's zoom in a little now to the Courtiers funds specifically. What's all this happening around us doing to the portfolios? What's it doing for opportunities out there? What's it doing for you and your strategies?
Well, as you know, we've sort of spent the past 2.5 years clearing bonds out from the portfolios because we didn't want to be holding them as long-term interest rates hit record low levels, which they did in the summer of 2020. And this rapid correction in interest rates this year has, for us, made bonds buyable again. So you're long dated now. If you're prepared to go sort of 20, 30 years, you get about 4% per annum. If inflation mean reverts, as we sort of think it will, comes back to 2%, then you're getting 2% premium for the term over and above cash rate. That's okay. So we don't want to be as in this environment. We think bonds can do a job for investors, diversifying risk, providing a steady income stream. On the stock side, all the analysts are really excited on Team. I think they feel that they're just unearthing lots of very, very good companies. They've got some difficult periods coming up, particularly in the UK because of this. We've had a massive change in the approach from the government in a very short space of time, where under Liz Truss we were going to be a low tax economy, and under Sunak we're going to be a high tax economy. One wanted a shrink government, Truss. The other one doesn't want a shrink government, Sunak. So in fact, I'd argue you've got more of a contrast within the Conservative Party than you have between parties themselves. But if you take that view, and the government now moving towards fiscal austerity with all the warnings from the Chancellor and the Prime Minister, then that is going to make the Bank of England's job easier, because the actions of the government won't be inflationary. So likely under Sunak, peak interest rate will be lower than it would have been under Truss. And I think the market has discounted that. That's why 10-year gilt yields dropped from comfortably over 4 to back below 4% when we had the change of Prime Minister. And we think that's reasonable. We suspect that inflation will peak soon and then start to drift downwards. There could be another shock, but there can be a shock in both directions. Peace may break out in Eastern Europe. And if that happens, it's likely that a lot of pressure on energy prices will dissipate quite quickly. And in the long run, as Germany is showing, it is rapidly adjusting to the lack of natural gas being supplied by Russia, and it's rapidly moving towards more renewables. Yes, it's had to keep some of its coal-fired power stations going. The UK will likely do the same. You know, we might not be able to be shutting down coal, oil-fired energy as fast as we like, but it will increase the rate with which we move towards renewable. So that's positive. And as we get down that path, and as renewable energy was as cheap as oil, certainly pre the war in Ukraine, with the war in Ukraine, it's a lot cheaper than most other methods of providing fuel. That is a good thing. And as long as it keeps going, as long as the energy sector keeps going in that direction, we're going to bring prices down. So it's likely this pain is short term. The worry is for if inflation expectations get baked in, and then you get this horrible spiral of rising prices. And that's what the Bank of England is, as they describe, leaning against. But I think they'll win that battle. I think the odds are they'll win that battle, and that makes bonds more viable again. But it's also very good news for equities, because companies won't be working on the basis that the interest rates are going to be high for a long period. And once the market adjusts to that, it makes the value of companies that we're holding at very, very low multiples extremely attractive. So, in summary, we are adjusting and steadily increasing our bond exposure, but we're very, very excited about the medium-term prospects on the equities that we hold.
Speaking of excitement, Gary, final question for you for now. Are you looking forward to this year's client seminars, and can you give us a little peek into what we might be hearing from you?
I am looking forward to them because it's a great chance to catch up with lots of people that you don't get to see. This was, the fact that we're a lot more back to normal than we were last year with COVID restrictions have affected in the past couple of years. I'm hoping there's going to be a great turnout and we get some excellent questions and some good debate. There's lots to talk about. I mean, it's been an extraordinary. My favourite December, Leo, would be on the back of a most boring year, because it would have meant that you've generally done well with your assets. When things are really interesting, they tend to be interesting for the wrong reasons, and there's so much to talk about this year with particularly with inflation, particularly with the big hikes in interest rates, what's happening with politics globally, renewable, that type of thing. But you've got the added excitement that we've launched our new ethical value equity fund, and Katie will be covering off some of the work done on that. That's very exciting. I know James has got some interesting things to talk about on the asset allocations. Jake's going to cover it off on some stocks, and I'm going to have a look and see where long-term interest rates are likely to go, how government policy has changed, and this issue of productivity. So there's lots to talk about. But the nicest thing about it is you catch up with so many people, and that it's my favourite month of the year. For that reason, I like the seminars, Leo. I thoroughly enjoy them.
I echo that sentiment. Looking forward to them very much. Gary, thanks as always for your time. I'll be catching up with you again soon.